Assets is today's chapter. An asset is a source with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit. An asset is a source with economic value that an individual, corporation, or country owns or controls with the expectation it will provide a future benefit. Assets are reported in a company's balance sheet and are bought or created to increase a firm's value or benefit the firms and are the benefits of the firm's operation. And asset can be thought of as something that in the future can generate cash flow, reduces expenses, or improves sales regardless of whether it is manufacturing equipment or a patent. There are two types of assets, current assets and fixed assets. You can see the company purchase those assets to generate any future benefits. Mostly it's considered as in monetary terms. Types of assets defined. Current assets are short-term economic resources that are expected to be converted into cash within 1 year. Current assets include cash or cash equivalent, accounts receivable, inventory, and various prepaid expenses. While cash is easy to value, accountants periodically assess the recoverability of inventory and accounts receivable. If there is any evidence that the account receivable might be uncollectible, it becomes impaired, or if inventory becomes obsolete, companies may write off these assets. Fixed assets are long-term sources such as plants, equipment, and buildings. An adjustment for the aging of fixed asset is made based on periodic charges called depreciation, which may or may not reflect the loss of earning powers for a fixed asset. Understanding current assets as compared to long-term assets, which represents the assets that cannot be feasibly turned into cash in the space of a year, that generally include land, facilities, equipments, or other illiquid investments. They are important to business because they can be used to fund day-to-day business operation and to pay for ongoing operating expenses. Since the term is reported as a currency value of all assets and resources that can be easily converted to cash in a short period, it also represents a company's liquid assets. Depending on the nature of the business and the products it market, current assets can range from barrels of crude oil or fabricated good, work in progress, inventory, raw material, or foreign currency. Key components of current assets: cash, cash equivalents, and liquid investments in marketable securities such as interest-bearing short terms or bonds are obvious inclusions in current assets. However, the following are also included in current assets: account receivable, inventory, prepaid expenses. Below you can see we have shown some diagrams to make you understand. The account receivable example is another example. You can see here account receivable, it is money due to a company for goods or services delivered or used but not yet paid for by customers are considered current assets as long as they can be expected to be paid within a year. If a business is making sales by offering long terms of credits to its customer, a portion of its current account receivable may not qualify for inclusions in current assets. So to qualify in current assets, it has the term period required is only 1 year. Anything above than that is not considered as current asset. Inventory represents raw material, components, and finished products is included in current assets, but the consideration for this item may need some careful thoughts. Different accounting methods can be used to inflate inventory, and at times it may not be as liquid as other current assets depending on the product and industry sector. Prepaid expenses, it advance payment made by a company for goods and services to be received in the future are considered current assets, although they cannot be converted into cash. They are the payments already made. Such components free up the capital for other uses. Prepaid expenses include payments to insurance companies or contractors. On balance sheet, the current assets are normally displayed in order of liquidity. That is, the items that are most likely to be converted into cash are ranked higher. The typical order in which current assets appear is cash, including currency, checking accounts, and petty cash, and short-term investments such as liquidable marketable securities, accounts receivable, inventory, supplies, and prepaid expenses. Understanding of fixed assets. A fixed asset is brought for production or supply of goods or services. Rental to third parties are used in an organization. The term fixed translates to the fact that these assets will not be used or sold within the accounting year. A fixed asset typically has a physical form and is reported on the balance sheet as PP&E. When a company acquires or disposes of a fixed asset, this is recorded on the cash flow statement under the cash flow from investing activities. The purchase of fixed assets represents a cash outflow to the company, while a sale is a cash inflow. If the asset's value falls below its net book value, the asset is subject to an important write down. This means that its recorded value on the balance sheet is adjusted downward to reflect that it is overvalued compared to the market value. When a fixed asset has reached its end of its useful life, it's usually disposed of by selling it for a salvage value, which is asset estimated value. If was broken down and sold in parts, in some cases the assets may become obsolete and will therefore be disposed of without receiving any payment in return. Either way, the fixed asset is written off the balance sheet as if no longer in use by the company. Example of fixed assets can be included building, computer equipment, software, furniture, land, machinery, and vehicles.